So welcome back to another strategy that is called as iron fly or iron butterfly. See, I'll be speaking very slowly and deliberately. Please hear me out patiently. Alright. In the previous lesson, we have talked about a straddle. When you sit in a position with one leg on either side and you exactly in the middle, that position is called as a straddle. And then we have also learned how a straddle is converted into a strangle by providing little more breathing space for playing but compromising or strangulating the profit. We have seen that, alright? Now what you see on the screen in front of you, this is a common house fly, and on top of it is a butterfly, alright? And on right of it, this is the strategy, or this is the payoff diagram of the strategy that we are going to discuss. Now some people feel that this payoff diagram resembles a butterfly. You see the top head portion here and the two wings. So they call it butterfly strategy, while some people think that it represents or it resembles a fly. So they call it a fly strategy. But why the word iron? Fly or butterfly is okay, but why the word iron butterfly or iron fly? The word iron signifies the strength or the protection that this strategy provides. How does it provide the strength or protection? Let us see that. Alright. Now you just remember when you were learning about the straddle, what you had done? You had sold a call and a put at the ATM and then taken some premium. Alright. The amount is not important here. Just try and understand the concept. Alright. Because you had sold a call and a put at the money, you had got a slightly higher premium. Alright. And because you had gone short, you call it a short straddle. So far it is okay. Now, because you had gone short, the losses remain unlimited. If the price of the asset goes below certain limit here, like it goes below 90 or it goes above 110, then your losses can keep mounting. The losses become unlimited, quite unsafe. So what do you do to protect your losses? If you can do something, see here, if you can do something to protect your losses, to limit your losses to this level, alright, on both sides. If it comes below 90, then the losses don't increase. Similarly, if it goes above 110, the losses don't increase. If you can do something like this, then it becomes an iron fly or an iron butterfly. Alright. How do you provide the protection? Let us try and understand that. See, when you had made a straddle, you had sold a call and a put here at the ATM. Alright. Now what you do simultaneously, you also buy a call at a strike little OTM at 110 here, this one. And because you are buying out of the money, you will pay a lesser premium than what you had collected at the time of selling the ATM. Okay. Similarly, you buy a put again little out of the money here at 90, and again because you are buying out of the money, you will have to pay a smaller premium. So in effect, what you have done, you have collected a higher premium by selling a call and a put at the money, and then you have also simultaneously bought a call and a put out of the money and paid back a small premium. Alright. So the payoff diagram becomes like this. You have provided some protection. What happens now? See, if the price goes below 90 or 110, your long positions start earning for you. both these left and right, the long positions which are there, they start earning for you. The short position will continue to generate losses. But since your long position is generating profits, ultimately your net loss will get restricted, will get limited to this point. The more your losses increases on the short position, the more your profit will increase on the long position, and ultimately the loss will get limited to a particular point. I hope you are understanding that point. All right. But what has happened? This iron cage has not come free of cost. You have had to pay something. See, when you had prepared the straddle, you were getting a higher premium. Don't worry about the figure, but just remember that because it was ATM, you were getting a higher premium. And then when you converted or you tried to make an iron cage, when you bought the protection, you had to pay back $4. So ultimately your premium is restricted to $6. All right. So there are no free lunches in the stock market. It is a level playing field for everyone, for the buyer as well as for the seller. So I hope you understand the difference between a straddle and an iron fly, or how a straddle is modified to make it into an iron fly or an iron butterfly. What you have done basically, you have limited the losses in a straddle. Here the losses were unlimited. Here the maximum loss has got limited. And because you got the losses limited, you had to pay something. Your ultimate premium got reduced. So compared to a straddle, the premium that you get in an iron fly or an iron butterfly is lesser. But at the same time, you also get the protection. Your losses are protected.